Okay, one important point to point out, this is kind of a little bit more of a subtle point, but as far as the new discount rate goes, and again, we see more of this in the school district example, but all of you can be thinking about it because I'm seeing a few more counties now set up irrevocable trusts. But the rules for calculating the discount rate under the current rules were similar whether you had an irrevocable or a revocable trust. So I call them the I or the R because sometimes when you say them it sounds the same, but you really could use a similar discount rate even if you had a revocable or the R trust right now. So if you were invested in equities there, we could use a little higher discount rate in either kind of trust. If you were pay-as-you-go under the current rules, again, it usually meant a lower discount rate because, you aren't expected to earn as much interest in fixed income type of investments. Under the new rules, only irrevocable trusts can possibly use a higher discount rate, if you're invested in some equities or something that's expected to earn a higher interest rate. GASB doesn't recognize revocable or the R trust monies as an official trust. So that throws you into looking at that 20-year high quality municipal bond index for revocable trusts, just like if an entity's pay-as-you-go. So that's a little bit of a subtle difference in the new rules. And again, this is a point that you may want to think about. If you currently have a revocable or the R trust right now, as you know, it's not considered, you can't offset it against your liabilities. And, in the new rules, you might have to go to a lower discount rate than where you are right now. So you might want to think about either making that an irrevocable trust or just make sure everybody's ready for that, liability kind of increase, what's going to happen, with your liability because of that revocable trust. So again, that's a subtle change in the new rules, but an important one to think about. And you can kind of go back and look and see what you even have. And again, it's mostly, a school district type of, but a lot of the school districts have revocable or R trusts. So this is something just to think about before you actually have to implement. So some of the new terms you'll hear, we've already gone over the entry age funding method. Instead of normal cost, you'll hear service cost. I think that's a better term because, with the move to GASB 45, it was really a switch to an accrual style of accounting. And we're accruing costs for all of you as you're working at your entity. So really, as you're finishing off another year of service, we have that accrual expense for you. So now instead of calling it normal, and there really wasn't anything normal about it, but now they're actually calling it a service cost because that's really what it is. Instead of just calling things accrued liability or unfunded accrued liability or assets, they've put some special names on them. Now your accrued liability is the total OPEB liability. Assets are fiduciary net position. And then your unfunded accrued liability is the net OPEB liability. So your total OPEB liability minus your fiduciary net position is your net OPEB liability. So again, those are some of the new terms you'll have to get used to here as we go forward. We've also added the element of, we now have, you'll hear valuation date, which you're used to already. We're also going to add in measurement date and reporting date. So typically now you've only referred to a valuation date and really your fiscal year end or your reporting date. Now we're going to kind of throw in that additional measurement date to you, and that's some of the roll forwards though that they're now allowing us to do that I talked about. So again, measurement date is new. Reporting date you've already had, but those two will kind of work together now, and you're allowed to really calculate your results ahead of time so that you're not scrambling at your reporting date or fiscal year end to get those numbers done, and that's what the measurement date really does for you. So again, we have a new term there. The next slide, I've just kind of mapped them for you as I've already talked about. So you won't refer normal cost anymore. You'll be talking about a service cost. There's no more ARC anymore, and that was confusing anyway because there was nothing required about it. So they've gotten rid of that. We'll just talk about an OPEB expense now. The net OPEB obligation, which was always confusing for everybody, just like with the public pension rules, they're doing away with that. So remember that it's the accumulative account of your liability, and that's what currently is showing up on your balance sheet. So you had your net OPEB obligation, it would increase by your expense, but then you get to take credit for any contributions or benefit payments that you made. So it's a cumulative account of what you've expensed versus what you've paid off of your liability. So that's totally going away, because that always was confusing. People would ask, well, what does this number have to do with the accrued liability? And I was like, well, that's a good question. You'd have to kind of map and get people there. They're going away with that. Now you'll really just move your true unfunded accrued liability to the balance sheet. So hopefully that will be helpful and less confusing. Again, the accrued liability, like I said, is the total OPEB liability. Assets are fiduciary net position, and unfunded accrued liability is net OPEB liability. So, and all the OPEB terms translate to pension, in the new rules too. So anywhere where you see OPEB, you can insert, pension, and you'll have kind of the same layout for GASB 68.